Hi teacher, my name is Maritza, and today with my whole team, Fabiola Polanco, Renata and Julieta Gomez, we are going to present you our final project, which is the 2008 global financial crisis, which is also known as the Great Recession. We will talk about some of the main causes and how it is spread globally, the consequences of it, the main impacts of this crisis, and of course like what policies or what actually help to stabilize the global economy. So let's begin. So first, a little bit of context of this global financial crisis. So as mentioned before, it started in 2008, and it was the most severe downturn in the global economic since the Great Depression that happened after World War II. So it began in the U.S. Housing and financial sectors of the country, but because of this new globalization and because the world was so interconnected at the moment, the crisis is spread rapidly across mainly Europe and Asia and some emerging economies around the world. So in short words or in smaller words, we can say that a financial shock that started in one country it turned into a global financial recession, sorry, because all of this interconnection. So what happened before this crisis like emerged? Like why didn't countries could like see it coming and maybe prevent it? So mainly the global economy was like really stable. I mean, countries had a strong growth, high liquidity, and there was like a really boom in the housing markets, and not only in the U.S. There was in many countries, for example, in Spain, Ireland, and many countries of the UK. But however, the stability was like misleading. Like people was focusing on the on the housing markets, but they didn't were considering also the financial system, which was like becoming very fragile at the moment, and it was like highly exposed to risk. But because countries didn't they weren't paying attention into that, that was the main reason like explode.
Okay, so now we're going to talk about the exchange rate system. This wasn't an exchange rate crisis, and that's like really important to highlight it because most of the advanced economies were using floating exchange rates systems, which means their currency could adjust naturally to the market conditions. When the financial panic started, instead of weakening, the US dollar like actually strained because investors saw that it was a global safe haven asset. So overall, exchange rates reacted like normally, and they were not caused nor the main trigger of the global financial collapse. And now the global causes of the crisis. The crisis had like several interconnected global causes. It began with the US housing bubble, where the banks were giving like risky subprime mortgages to the borrowers with a low credit worthiness. So these mortgages were like the bundle into the financial products and sold to the banks and the investors around the world, spreading the risk internationally. And at the same time, the financial institutions were like highly leveraged and operated with weak regulations, which made them like extremely vulnerable. And when the defaults increased, the entire system around the US, Europe, Asia, all around the world, and even emerging economies feel the impact.
In this slide, we can see the main moments of what the crisis was about. So in 2006, the housing prices peaked. In 2007, you can see that the financial tensions began. Then in 2008, there was a collapse of the Lehman Brothers, which triggered the panic globally. In 2009, the world entered a deep recession, and in 2010, the European debt crisis began. Now, what about the global economic impact? So, economically, the impact was massive. The global GDP fell more than 2%. The unemployment increased everywhere, especially in the US and in Europe. We have the global trade that dropped sharply. The housing markets collapsed in several countries, and the banking system faced failures, bailouts, and a severe credit contraction. Now, what was the global policy response? So, to stop this collapse, countries took strong actions. So, central banks cut interest rates to almost zero. Then they injected liquidity and they launched quantitative easing. The governments implemented physical stimulus like TARP in the US and a massive package in China. And new regulations were introduced, such as the Basel III and the Dodd-Frank.
It became a financial crisis because financial markets, banks, and trade were deeply interconnected. Once panic started, it spread through capital flows, banking networks, and falling demand around the world. In conclusion, the 2008 crisis proved how interconnected the world economy really is. A shock in one country can affect everyone. Thanks to coordinated actions, monetary, fiscal, and regulatory, the world avoided a deeper depression. The crisis changed global finance and highlighted the need for strong oversight and international cooperation.
Thank you so much for your attention, and this was a little bit of a resume of what the 2008 crisis was about.